Welcome back to STC Blueprint. In lesson 1, we covered market structure, the heartbeat of the market, but knowing the direction is only halfway. The real question is, where do we enter? Today, I'm going to be showing you the footprints of big banks. You are moving away from retail support and resistance and diving into institutional supply and demand. By the end of this video, you will know exactly how to draw your zones and how they actually hold. So today our topic is going to be supply and demand, and I'm going to show you a quick example of how supply and demand is. So this is a diagram of supply and demand. What is the brain or the theory behind supply and demand? Supply and demand is actually one of the most simplest concepts which a lot of people don't know about. I'm going to teach you now, and I'm going to teach you how supply and demand works. So basically, the demand zone is where the market buys from. The supply zone is where the market sells from. So what is the theory behind this supply and demand zone? Now, before you identify a supply and demand zone, there's something called a candle body and the candle wick. I'm going to be showing you that. So the market creates a body. The market creates a body and the wick, which means this part here is the body of the candle, and this other part is the candle wick. Now, when the candle or when the market creates a big gap, and gives a little wick, just like this, let's say it created another wick here, then there was a candle that was printed before it that also had a wick. And from the upper zone, there is also another candle here. So this is an example of a demand zone. Now, what do I mean by a demand zone? I classify my demand zone is identified when the market leaves a big gap. Now, this gap between these two candle wicks, let's change the color. Now, I'm deleting this. Now, this gap between these two candle wicks, this gap is going to be called a fair value gap. Yeah? This gap is going to be called a fair value gap. I know you might not be able to see it clearly. A fair value gap. So this is a fair value gap or FVG. Now, in this case, this confirms that there is a demand zone lying just below here. Remember, the demand zone is where the market buys from, and the supply zone is where the market sells from. Now, where is the ideal place for me to put my demand? Just below here. Now, apart from finding or understanding the whole concept of how to make or to find out your demand zones, now what is the concept about this? You know that normally when the market goes and it comes into a fair value gap, there's always, or it's not always, or most times the market reacts from the fair value gap, meaning that the market comes like this, maybe gives a push up. Let's say the market gives a push up, comes into the fair value gap and go up. But my concept tells me, or it teaches me, that the market is always going to come back to the demand zone. Now, what is that demand zone? This demand zone is a place whereby big or institutional traders were able to push the market. This is a place in price where institutional traders were able to buy the market. So that is why they pushed the market so big, so fastly that it left a fair value gap. So if the market comes back, it means that the seller or the buyers, those are the institutional people, they will be okay to buy from this price. It's just like you buying an asset for $20. Okay, let's write it. It's just like you buying an asset for $20. So after buying the asset for $20, let's say it increased. Let's just give a diagram. Okay, let's say it increased. Let's say at this point it was now at $50. Sorry, it was now at $50, and you see that the market is selling back. If you were able to buy at $20 and you were able to sell at $50, now you made money. When the market comes to $20, it's actually a good idea for you to buy it again at that $20 and expect it to exceed this $50 according to the principle or the according to the theory of what of a trend. Now, this is an example of what I'm trying to say. This is an uptrend. This is an uptrend. So the markets moved or it pushed up, came back to a demand zone where the buyers or the institutional players were able lost like a discount price where the institutional players were able to buy the market. Now, after buying from here, the market gave another push up. Now it came down here. Let's say it gave a push up around this side, and maybe the market was not didn't create any fair value gap there. It created a fair value gap here. Now remember, this has already confirmed this part of the market. This part of the market has already confirmed a break of what? Now a break of structure. Now after a break of structure is formed, what are the next thing that you should be anticipating on? You should be anticipating on a reversal. What is a reversal? Remember that this is a higher high, a higher low. The market will create a higher high and also must create a new higher low. So what you should be doing now in a bullish market like this, that is an uptrend. In an uptrend, you should be anticipating to buy after the retracement is done. So after the market gave this break of structure, it gave this higher high. Now we saw that the market was coming back. What do? You mark out a demand zone whereby the market gave a very big push up, and that is a very good zone for the market to buy from again and give a new higher high. Just like this diagram here. This is another break of structure. This is another break of structure. And you see that that is what the market does continuously. If you can read the market well, you will see that that is what the market does. So this also applies to selling. So let's say we wanted to sell the market. This also applies to selling too. Okay, so what does this now? This is a supply zone. So if you see a red box or a red rectangle, it means that this is a supply zone. Now, what does the supply zone mean? The supply zone means since the price has bought from here, now there's a place where the market will start falling from to create a new what? A new higher high. That is a supply zone. Okay, so in a downtrend, we sell on the supply zones. You understand? So in a downtrend, we sell from supply zones. Now, this is an example of a downtrend. We saw that the institutional players were okay or were happy to buy from this zone. Now, after buying from this zone, the market went to a place where maybe another supply zone. Now, the market sold from there, created another place, another zone. That's just the whole theory. So you sell in a downtrend and you buy in an uptrend. I don't know if you understand. All right, so I'm going to be taking you to the charts now to see it more clearly. So now we'll be looking at this pair. This is the USD card. This is the United States dollar. Sorry, United States dollar against the Canadian dollar. Let's reduce this a little bit. Okay, so what can we see here now? So we'll be cutting out this whole place. Let's cut from here. So your focus should be from here, this whole marketplace. So now what can we see in this? We see that there is a very visible what? There's a very visible uptrend in this market. This is what we can identify in this market. We see that there is what? A very visible uptrend in this market. So let's get to explain what really happens here. Now we see that in this uptrend, and remember, not all supply zones or demand zones. Sometimes you don't really get hit. Maybe you can mark a demand zone, and sometimes you might be ignored. So let's dive into this. Now we see that from this part, we can identify what I taught you. Remember, now what can we identify at this part? Let's delete this. Now what can we see here? We can identify that there is a fair value gap at this point, which we can put as what? Imbalance. We see that the market created a fair value gap here. And now what did the market leave? It left behind what? A demand zone. So we see that the market left behind what? A demand zone. And what do we see happen now? We saw that after this push up, where this was where the institutional players were able to buy the market. Now, after they pushed up, they sold at this point. Now, it all lines up now. We see that after the push up, there is also there's also a supply zone found here. We can see that there's also a supply zone found here. So what did we see now? We can identify that the market pushed up, created a demand zone, reacted from a supply zone, came back into that demand zone, and started what? Buying. Now, this is a very, very simple concept. So let us, reduce the time frame now to explain what happened right here in this whole market movement. Now, we can see that after the market gave this push up into the supply zone and started selling, it came back now. So to refine it more, because we're on the daily time frame, now what you can do for yourself, instead of having a big demand zone which might affect you, what you can do is to go to a lower time frame and refine your zone. Now in the 1 hour, sorry, this is the 2 hour time frame, we can see that this was our zone. Now when you see that the demand zone is too small, what you have to do is to enlarge it. So if we're to buy from here, we are going to put our stop loss just a little pips. Maybe we'll be using this candle wick around here, just a little, wick, or just give it space. You understand? So after the market, we can see that the market sold from this supply zone, created a demand zone. Now, what do we watch out for? We watch out that after it reacted from here. So let's say we are going to use what? Confirmation to enter this market. We can see that after the market reacted from this demand zone, it gave a push up. Okay? So after giving this push up, what can we identify here? We can see that this now is significantly what? A downtrend. This is a downtrend. Okay? So after at this downtrend, where was the last lower high? This lower high was here. Now this was the last lower high the market formed. And we can see now that the market closed above it with a body, which is not what's normal in a downtrend. Now, what do we classify this as? Now, we can proudly say that this market has created a change of character, meaning that the market is about to change what? The movement from a downtrend to an uptrend. And that's what we see here now. So what can we identify here? We can see that after this change of character now, there was another what? Impulsive move. Now, on the 1 hour, don't get it confused. Now, we can identify that there are two demand zones here. We have one. Let's make it blue. Let's change the color here. And we have this demand zone and also this what? Demand zone. Now, what can we do here? When we see that this market has given this change of character, what we do is we go to a higher time frame. Now, we can see that this is a zone. Now, we can identify that, yes, there is a demand zone here. And from here, Remember, this was the zone we saw on the 2-hour time frame. So leave that I'm not marking it out at this point. Now let's just draw a line to show here that this is the 4-hour demand zone. Now we can see that this is a demand zone and this is also a demand zone. But what did the market do here? The market went to the premium. Now, what does this mean? There's a tool called the Fibonacci tool. So if you were to place the Fibonacci tool at this place, now to the top of this place, you see that this place was what? A discount price. So although here was also a discount price, but this was a much lower price for the market to do what? Buy from. Now on this 4-hour time frame, we can see that this is the only time frame, or this is the highest time frame which presented us what? With a demand zone. So what can we do here? We can simply use this as inducement. What does it mean? This is, I remember what I taught you in the last video. Inducement meaning is going to create what? Some kind of equal lows, tricking traders that think into thinking that the market has started to what? Buy and give its main what? Move. So this is inducement. Sorry. So at this inducement, we can see that the market gave this big move. Now you see that at this point, you see this blue candle. Now we can see that this candle would has this would be what, or this is what we will mark as our inducements, because we saw that as the market reached this point, it gave some kind of push up. Now they will be on a little profit, but after that the market did what? Sold back into this premium zone. Okay, into this discount zone actually. So we can see now that after using this confirmation, this is called a confirmation entry. So if you enter down at this point, this is called a risk entry. So you are risking it without any confirmation. You just bought it anyway. Okay. But now for confirmation entry, we can confirm now that the market has given a change of character. And now we know that the market is what? Is ready to start buying and change the trend. Now what can we simply do? We wait, or we mark out we mark out the two what? Demand zones. We saw that the market formed this demand zone and this other demand zone. And what did the market do? It created inducements here, gave fake buys and sold back into the main what? Into this main what? Into this main demand zone. Now from this demand zone, what can we do? We can actually buy from here. Now we can buy from here and maybe target higher. Now, one thing about demand and supply is that it gives you good risk to ratio. So if we saw this trade, this would have given us, this one is a 9.71 risk to reward. This is a 9.9. That is almost a 10 risk to reward, which is something you don't really see on most strategies. So let's get away from that side. Now we can see here that this market, after doing this, after going out from here, we saw that the market created what? A new high. A new higher high, which created what? A break of structure. Now, where is that candle that broke that structure? We saw that this is a new candle that broke the structure. Now, after marking this out, after seeing this now, after seeing that there was a break of structure here, what can we simply do? What we have to do is to mark out what? Demand zones. Now, marking out demand zones, what we can see here is that the market fell to this place. So normally what I would have done without seeing this now, if I wanted to buy the market, this was where I would do what? This was where I'll be buying the market. But we can see here that the market did what? It hit our SL. So this is to tell you that not every entry, or there's you can't get TPs on every entry. There are some that will hit what? SL. There's no strategy that is perfect in giving you 100% win rate. So we can see that this demand zone gave us a stop loss. Now let's go further. Let's go to daily. Now, one thing I want you to know is that supply and demand works in every time frames. Now, we can see on this time frame now that this was an uptrend as we signified and we cut this move. Now, from this uptrend, what can we see here? Now, based on the daily, we were on the 4 hour. That was why we were considering what the inner trends. So there are two types of trends. We have the inner trends and the major trends. So this, we are marking out the major trends. So we can mark out here, here, now here. Before the market gave this one, it did not give a new what? A new higher high. So it kept on falling until this point. Now here, here. So from here, what can we see now? We can see that at this point, the market did what? It gave a change of character. What does a change of character mean? Now it fell below the most recent lower higher low. It fell below the most recent was higher low. Now from this higher low, what can we identify here? This is a change of character. Now what I actually do is there are supply zones here, but the trick I use is that I only trade the supply or demand zone that causes the change of character. Now from here, what can we see? We can see that there was a supply zone here. This was the last supply zone that gave that impulsive move for that change of character. So we can simply mark out here as a supply, mark here too as a supply zone. So when dealing with change of character, what do? We mark out the supply or demand zone that caused that change of character. And from here, we can see that the market came back to this supply zone that caused this change of character and sold off. So me seeing this now, as I saw this change of character, what I'll be anticipating now is to sell from this supply zone. So what we'll do here is put a sell limit here with our stop loss just a little above the zone. Now we can be targeting this lower low as a take profit. And we see that the market played out just perfectly on that. Now we can actually see that at this point too, the market gave what? A change of a break of structure to the downside. What can we also identify? We can identify here that there was also a supply zone here. And what did the market do? After giving this change of character, the market sold off, gave a break of structure, now went back to a supply zone to sell off, now to create a new what? Lower low. So that's the whole concept. So with that being said, what I want you to do now is go to your chart and go and find supply and demand zones. Tick them out and see the ones where the market did what? Reacted from. So that is your homework. Find out 5 supply zones or demand zones, screenshot them and send it on the comments. Thank you. See you in the next video. Please don't forget to subscribe.